Ladies and gentlemen, thanks for tuning into The Scoop. I'm your host, Frank Chaparro, Director of Special Projects at The Block, and you can hear on the other side of the mic the CEO of BitGo, Mike Belshe, joining the program again, I think for the third or fourth time, but I don't have the proper count. You'll have to, there's a sort of tally going that I have of the top few people. So you're just, I think you're in the second tier. We got to get you into the gold tier, and then we'll send you over some scoop shoes. Anyway, I kind of want to go on this thread that we were talking about. We're in a bull market. People are more active. They're more exciting. What does that mean for BitGo? How's business?
Well, business is great. I mean, assets under custody, I was hoping to get the report this morning, but I think it's going to be at all-time highs for us. That was about 68 billion was our largest ever that we had posted back in the last bull market. But the products and services that we offer have really expanded. So for those who don't know, BitGo is a couple of things. First off, we are a security-first wallet technology platform. We pioneered multi-sig all the way back in 2013. We've raised less money than any of our competitors, and yet we've been around twice as long as all of them. And that's because we've been pretty broad in what we offer. We focused on institutions early, maybe too early to some degree. But since then, we've expanded a lot. So today, we're mostly known for our custody offering. We still have our full wallet offering. That's a Fireblocks type of thing, if you will. Everything is multi-sig and MPC, threshold signatures. Heavy focus on security. And then on the custody side, heavy focus on offline cold storage. So obviously, with the ETFs that have just been launched this year, that's, of course, in big demand. And then lastly, I think things that people don't know about BitGo, and I'm not sure if I've announced this anywhere yet, so maybe you're the first to hear it. I think we're either the largest or the second largest staker in the planet. Most people think of staking as, Block Daemon and Figment, and, there's 20 odd, staking infrastructure folks. And we're $25 billion of staked assets here at BitGo. The only one I know that's larger would be Lido, which is, of course, the tokenized liquid staking for Ether. So anyway, really, really large there. And, that's been a huge focus for us. What's happened that's different now than a few years ago, of course, is everybody at the institutional level needs custody. They like the bankruptcy remoteness. They love the regulatory structure that BitGo has. They love the coin support, the deep cold storage technology behind it. And then, of course, they want to be able to stake and get yield. And so we've just been growing that service pretty steadily over the last couple of years. And you throw in a little bit of asset price appreciation, and suddenly it's large.
So obviously, custody is a really interesting segment, and we've had conversations about that business over the past 5 or 6 years. One thing that we really haven't seen, right, is have we seen much in recent in this cycle consolidation compression in fees, or has it stayed pretty steady?
Well, these days we offer a number of services. Actually, I remember being on a panel with State Street was on the panel. I think it was probably like 2017 or so, and they're just trying to figure out digital assets, and they get up there and they say, well, custody, really it's all about the services you provide on it. And in traditional finance, it's true, right? Like custody is commoditized, and so then you add services around access to liquidity, collateralization services, and lots more as your way of making money. Now, in the crypto space, there's those that think that custody is commoditized already, but it's really not. And this is very simple to measure yourself. There are 0 pairs of 2 custodians that look exactly alike in our space. So custodians have different regulatory structures. They have different coin support, different technology, different service, been around different lengths of time, different balance sheets, et cetera. You really can't find any 2 that are purely interchangeable. Of course, BitGo having been around the longest, I think we've got the broadest customer base, the broadest service and product offering base. So that helps us quite a bit. But yes, it also allows us to move away from just pure custody fees. People don't like to pay, just fees on custody. It's not very rewarding. But having the custodian make a little bit of money through your liquidity or through your staking or through your collateralization or your lending, that's actually much more natural. That's more like a pay for service type of thing. So overall, it's allowed us to grow revenues, make the business more healthy, align our interests with our clients even better, and hopefully be a great service provider.
So what does the competitive dynamic look like in that type of market where no custodian necessarily looks the same in terms of competing after a client? What does that business development look like, right? And maybe as it pertains to these ETF issuers specifically, I think everyone probably wants to take some of Coinbase's pie. You've seen Kraken announce that they want to get into the institutional custody business as well. And then there were players that used to exist that don't really exist to the same extent, like a Back. What's the competitive dynamic right now, and how do you win market share? Is it just about it's not really going after them with custody? It's okay. Do you have this other problem? Then we can also do that as well.
I think you end up looking at kind of different competitors in different segments. So BitGo hits a lot of different segments. Of course, you've got retail. We don't hit a lot of that. We've been institutional more. Totally. But then inside the institutional space, what do hedge funds need? And how does that differ from what venture capitalists need? How does that differ from ETFs? You mentioned ETFs. Well, that's a Bitcoin only product. And kind of down the line, there's a number of differentiators, RIAs, and others. I would say with regard to custody for the ETFs, since you asked about that, look, I think BitGo kind of stands alone in a couple of aspects. It is true that Coinbase won some of the initial ETF custody, but I think the reasons, if you look at it, is actually pretty simple. Challenge number one for all of the ETF issuers was getting through the SEC. So what they put into their applications was whatever would let them get through the SEC as quickly and smoothly as possible. Does anyone issuing an ETF want to have a single custodian? No. And this is not specific to Bitcoin. This is, broadly. Of course, they want to have a number of service providers. They want to do that, heck, just so that they can get a better price even, right? They want to make sure that they're not locked into a single vendor. So because the job number one was get the approval, none of the applicants said, hey, we're going to use two custodians and here's who they are, because that would elicit review from the SEC for two vendors, which is by definition more complicated than doing it for one. But now that the ETF is kind of launched and it's more stable, of course, all of the vendors, all of the ETF issuers are looking for additional providers. So I think we'll see change there. And also good news, like the guys that are issuing the ETFs, these are traditional, stable firms that understand what they are doing. So of course they want to make sure that they are protecting their clients, that they're doing it in a highly regulated and compliant manner. So it all kind of fits in with what they normally do anyway.
I don't want to get too much into I do want to touch regulation, but I don't want to go on a tangent right now. It's kind of funny how the SEC, the way they approach this, right, resulted in so many, it sort of created a situation where a lot of the components of the ETFs were not as, were deficient in some ways, insofar as you because of what you just described, right? You don't have multiple custodians. You also had the in-kind or cash settlement versus in-kind. And it's like you wonder what their motives are or what they're interested in terms of just how they how the cards sort of, fell on the table in that way. It's just bizarre. But
we can go back to the past. And I do think the SEC actually plays a hand in, some of the failures they had at like FTX. Like imagine people that would have been instead in a BlackRock ETF, but instead ended up at FTX. And of course, there's a very large non-zero number of people that are in that boat. So look, we can go and beat the SEC up over that. On the good news side, now that we have the ETFs launch, we've seen the market has a strong appetite for this, which is really good. There was a fear about whether that would work. Heck, there was fear about whether the authorized participants, who are a couple layers below the issuer, right, with providing liquidity, would they be able to provide enough liquidity to match the demand of BlackRock and Fidelity? And good news, that's held up so far. Now the in-kind redemptions is an interesting point because, without that, the spread difference between the ETF and the underlying will diverge a little bit more. And,
Yeah.
the market makers in the industry don't have all of the tools that they would normally use to make sure that buyers of the ETF get the best price. Look, I think in the long scheme of things, regulators are still worried about compliance a little bit. They're worried about where the fund's coming from. They want to make sure this is tied up. You can agree or disagree with whether they should be focused on that. But look, I think we have a huge win with the ETF. I think it allows us to start talking about second level things instead of just kind of the first level of can we have these assets at all, which is a great move forward under all measures.
So let's go back to maybe BitGo's growth and what things look like at the firm over the last few quarters. Obviously, that AUM growth is not just driven by price go up to the right, but also an actual growth in clients. I think you guys had a 60% increase in 2023. What does the client profile look like, and what type of new market participants are you seeing on board?
Well, we hit all segments. So we hit everything from the technology guys. So a lot of times somebody has their own regulatory structure, and then they're going to deploy our wallets and technology into that. In Japan, they use our cold storage, all operated under the cryptocurrency licenses there. We sell globally, and we sell about half in the US and half outside the US. Outside the US is more dominated by the technology products. In the US is where we see more of our regulatory products. Our international trusts are also growing. So we're the only company in the space that has 7 different custodian licenses around the world. So we've got actually 3 here in the United States. That's South Dakota, Wyoming, and New York DFS.
And then just recently, Singapore, right? I think you got the regulatory nod in January from their regulator.
Yep, that's an in-principle approval. So we're working on the final steps of go live there. We have Dubai now, and then also in principle in Dubai, but finishing up quickly. And then fully launched cold storage, boots on the ground in Germany. And that's fully MiCA ready solution. So as soon as Europe gets some of its passporting done, it'll be a lot easier to be a service provider there. Why are we doing that? Well, we're doing that because we're servicing clients everywhere. And I think over time, increasingly, clients are looking for how do they interface in their local region, be able to keep their money both from a compliance and from a legal perspective within that region, and yet have the full complement of products and services that you would expect. So BitGo's able to hit that kind of across all aspects of the globe now. And then the next thing we do is we start to connect that for settlement globally, which is a thing we really haven't had in our asset class at all up until now with the BitGo Go network.
How has that been growing? This sort of, you can think of it as like a connective tissue between different types of market participants that maybe to an extent fills in the gap left behind the collapse or the downfall of Signet and Silvergate.
Yeah. Well, you're pointing out a good point. So, I mean, people don't realize it, but BitGo does a lot of US dollar, and we can touch dollars directly as well as through stable coins. And, the technology only providers that are out there, they can't touch dollars, right? They don't have a regulatory capability to do so, whereas we can. And unlike Silvergate and unlike Signature, unlike Customers Bank, not only do we fully touch the US dollar side, but we also, of course, are experts on the crypto and digital asset side. So this allows us to create true DVP, delivery versus payment, for post-trade activity. It fits right within kind of what traditional financial players are expecting. And that's been growing super well. People realize, wait a minute, I can keep this in fully segregated, bankruptcy remote, qualified custody up until the very last nanosecond before swapping an asset post-trade. And that provides a lot of protection that they just haven't had without the Go network. So we're proud to be pioneering that, and that's been pretty strong.
I think one of the biggest problems, right, in crypto is that these trading firms, these different types of market participants have to face off against various exchanges, leave capital on there, which results in risk versus just having a sort of one place to kind of do all of the trading that they need to do, whether it's hedging, derivatives, spot.
Yeah. So there's the missing element of let's get into regulation, right? So, we hear in the U.S. that we have a lack of regulatory clarity. To some degree, that's true, but the word regulation covers a large set of items. So you really have to kind of break it down and prioritize a little bit. And so let me try to do that. I think it's super important for our industry and people to really get familiar with kind of this. I would argue that regulation, you can break it down into three groups of things. Number one is law enforcement related items. Mm-hmm. This would be AML, anti-money laundering, KYC, know your clients, transaction monitoring, sanction controls, things like that. It's a very well understood element of what we do. In spite of what some of the naysayers would say, BitGo and Coinbase are some of the best at this law enforcement angle compared to any financial institution, including all of traditional finance. And the reason is because we start with technology first. We are absolutely compliant with what our regulators are wanting us to do. And you can see that traditional finance has really struggled with this, with massive multi-billion-dollar fines every single year from JP Morgan and Wells Fargo and Deutsche Bank, like all of these guys, right? So anyway, law enforcement is number one, super important. And frankly, the digital asset companies are the best today. Okay, that's number one. Number two is investor protections. So this is really the turf of the SEC. And if you're going to offer a security for sale in the United States, you need to make sure you comply with proper disclosures. You need to make sure that the market is strong enough that it can't be manipulated by bad players. You need to make sure that you're getting the right price. You need to make sure that brokers aren't, pumping it to their clients while selling it out the back door at the same time. And these are basic protections that the U.S. pioneered all the way back to 1940. They're very important. There is a lack of regulatory clarity here, and it can be bad. The SEC shut down this token called library token. Do you have any library tokens, Frank?
Unfortunately, no. Thankfully, I guess.
I didn't either. I'm sure it was really bad. I'm glad that they shut it down. I shouldn't say I'm glad. I'm sure that they shut it down with good reason. But when one token has a problem, it's a contained thing, and also I think there is a caveat here, which is caveat emptor. Be careful of what you buy. Do your own research when you're investing. Okay, I'm not trying to dismiss it, but I think the problem scope of the SEC is actually a lot more narrow than the third aspect of regulation, which is really important, and that's market structure. Mm-hmm. And market structure make sure that the participants in our trading markets are abiding by a set of rules so that we can have really robust and strong markets. Imagine if Apple, which is sort of like library token, made some mistake and it took down the entire market for everybody, from Microsoft to Tesla to everybody else. Well, that would be very, very bad, right? But that doesn't happen because we have market structure. And market structure defines the role of an exchange, the role of a broker-dealer, the role of the clearinghouse, the central clearing parties, all this stuff, custodians, banks, and make sure that those that are providing kind of that center rail, the part which keeps the market up and running, don't take risks that are going to take the entire market down. Now, of course, we've seen risks being taken that took the entire market down. We saw it in crypto. That was at FTX, right? That was at Mt. Gox. That was at CoinCheck. That was at Quadriga CX. Why is market structure so important? Market structure means that you can continue to trade, the markets still exist, people don't lose billions of dollars, and yet, there can be failures on little tiny things like a library token. I'm not saying that library token, if it's doing bad things, shouldn't be fixed. It should. But what I am saying is that the order of magnitude of structural failures from having poor market structure is so much larger than the impact of a single token that in general, you're going to prioritize market structure. That makes sense?
Yeah, it makes sense. The market structure bit is a bit more insidious because it's not something that someone who's interested in punting a token could necessarily see. It's a bit easier to see a scam and know that it's a scam and not invest in it, at least in some instances, hopefully.
But this is a place where this is still a really important thing, and I think Coinbase is a very good company. They're doing a bunch of fights that are really important with helping sort out, the regulation. But I'm going to give them a little bit of criticism here, which is that at the end of the day, right now, today, the Coinbase model is the same model that Sam Bankman-Fried was advocating for with FTX. They want to own everything. They want to be the exchange. They want to be the buyer's broker, the seller's broker. They want to be the clearinghouse. They want to do the whole thing. And it puts them in a very interesting and, frankly, pretty troubled spot. We know that it has to separate apart at some point, and in some ways, the SEC being so powerful on that investor protection component and spending so much time there is forcing Coinbase to go and deal with that. But there's a much more important structural piece which has to happen, which is, of course, this market structure. And I think we can do it better than we've ever seen it in traditional finance. And that's what we're working on with Go Network. We're pretty proud of it.
Where do you think this sort of boundary should be drawn? What if you think about, post financial crisis, right? You can't, trade client money proprietarily. Never the twain shall meet. What type of businesses should an exchange not operate in?
Well, a couple things. You could think of the traditional market structure and the way that works, but you end up with a lot of participants and a fair amount of overhead. I think we could do that. It would be okay, but I think we can do much better. And I think you need to start with a bit of a first principles approach. And it turns out that investor protections or market structure protections are very similar to security. They're very similar to what you would do to just make sure you don't lose assets. And it means checks and balances between different parties. It means having, somebody that's responsible for the expertise of the secure and storage. And you could argue that I'm talking my own book here, but you've heard me say some of this, for the better part of a decade at this point. Yeah. And I honestly haven't heard people that said that this is a bad idea. I mean, it's I think pretty solid, tried and true. So number one, just kind of separate apart, the guys that are trading versus the guys that are securing and holding the assets on behalf of clients, and make sure that both of them are kind of keeping a check on each other. One of the reasons the exchanges end up in a difficult spot is, unlike custody, which frankly has no misalignment between regulators and the service provider, the custodian, and the investor, trading does. So when it comes to how exchanges make money, they make money by listing more assets and doing more trading. Mm-hmm. So they want to list every asset. Whether it has proper investor protections or not, they want to list it. So there's this natural tension where the regulator's like, whoa, hold your horses. We need to make sure this was done right. And the exchange is like champing at the bit to just get going and trading. That's where that tension exists. Conversely, in the custodial space, you just don't have this tension, right? What is our job? Our job is keep the assets safe and work with good people. Mm-hmm. What do our clients want? Keep the assets safe, work with good people. Don't screw up my reputation. What do the regulators want? Keep the assets safe, work with good people, right? So again, there's no conflict there, and that's why.
But why wouldn't you want to custody as many types of assets as possible?
Well, but we're not involved in any of the purchasing decisions there. Look, you, Frank, if you want to buy library token, that's your evaluation to do, and it's your regulation and things like that. And you're in the United States, you're going to have one set of regulations, and there could be, a Frank clone number 5 who's in Canada who's got a different set of priorities and regulations. So the buying and selling decision is yours, and that's outside of BitGo. We don't help you with that, but we help you secure it. Whatever it is that you have, you want to give us your car for us to keep in custody, we can do that. You want to give us shares of your company, we can do that. You want to give us your digital assets that you bought, we can do that as well. It's your job to do good investments.
What do you think is really driving the market right now? When you think back on previous cycles, doesn't it feel like this happened with such haste, this run up, that it almost, I feel like, caught many people by surprise. If you think about 6 months ago, you saw a lot of firms exiting or slowing down, whether it was NASDAQ on their custody initiative. At that point, I feel like a lot of people didn't ever foresee the market getting to this level in terms of price. And we're here without a lot of different things, right, Mike? We're here with higher rates. We're here without any sort of credit market. We're here with the majority of our banking infrastructure gone. So what explains the current price action? Is it really just the flows that we're seeing?
Super simple. Distribution channels is it. So look, crypto is hard. It's a new set of topics, things to learn about. How does it work? I thought that thing was backed by nothing, that crazy Bitcoin stuff. What is the regulation around it? How can I use this? What's a wallet, a private key, a miner, a Satoshi? Like all these things are foreign new concepts. So distribution of something that's got such an educational learning curve takes time. And I think actually, if you look at like the Bitcoin adoption, given those hardships of all that education, has been nothing short of amazing. And it shows a fantastic job. But nonetheless, in spite of it, the ETFs are the biggest distribution channel we've ever seen, especially when you want to talk about dollars. All of a sudden, basically you lit up 100% of all US investors can now have access direct to Bitcoin. And Bitcoin is doing what it was designed to do, which is to be a fixed supply, inflation resistant asset. And it turns out it works. So I think the best price predictors for Bitcoin, that is the people that are doing it, are looking at basically the inflows versus the outflows. That is, what is the daily inflow pressure versus the daily outflow pressure? And when there's more inflow than outflow, you got actually a pretty, almost theoretically pristine supply versus demand measurement you can do.
As is often pointed out by Matthew Hogan at Bitwise.
Does he say the same thing?
Yeah, there's a huge imbalance between the Bitcoins that are being produced and the number of Bitcoins on a daily basis that are being demanded via the ETFs.
Exactly. And look, I think there's one other thing which is happening, which is, the COVID money print, whatever you want to call it. Look, we had a global pandemic. Every government across the planet printed a lot of money. There was a massive supply of fiat currencies. That then led inevitably to inflation. As inflation starts to kick up, the Fed jumps in and says, we got to raise interest rates. As soon as the US started raising interest rates from 0 to 1, 2, 3, 4, now 5%, right? The dollar gets super strong against all the weaker currencies around the planet. And so you see this with, massive inflation occurring in Argentina, Venezuela, Turkey. Who was it that was just this last week? Somebody additionally, come back to me. Anyway, the weaker.
There's a lot of inflation happening.
The weaker currencies, see it first. And even here in the U.S., we got a presidential debate going on, fighting about, is the economy good or bad? You'd think that would be an objective thing, but apparently that's not even objective. And as citizens of the U.S., anyone can kind of look at this $33 trillion of debt and you're like, okay, that's a problem. And you look at the deficit on an annual basis, you're like, how's that going to work? And people are losing confidence in fiat because of what the governments are doing. But I think also a second factor, I think the internet is really kicking in here, which is we have a level of information dissemination today that we didn't have 20 years ago. And, political fights and discussions about inflation and other things, it used to be, you kind of got what came across the TV. And now there's so much information out there. People are getting smarter. They're getting smarter faster in all corners of the world. And this is fantastic news. It means that the individuals, the people, the folks that governments are supposed to work on behalf of, regardless of which country you're in, are now able to be a lot smarter about whether the policies their governments have is good. And they're looking at it, they're saying, you know what, that fiat thing ain't going to work. This Bitcoin thing makes a lot of sense. And even though some of those fiat status supporters are saying that the Bitcoin thing ain't going to work, it smells to me like it's the other way around.
Yeah.
So anyway, that's what's happening right now.
And that's what's driving the allocation on the part of, I guess, a lot of individuals, but probably, some of the hedge funds that might be onboarded as clients at firms like BitGo or Coinbase. They see it as back in 2021, as we were getting out of.
slightly different take about what's happening right now. There's been a lot of discussion that institutions are coming in. I mean, to some degree, there's a little bit. I think some of the smaller ones, smaller hedge funds are coming in, a little bit of RIAs, not that much. Actually, I think this is still mostly retail demand. And the reason we think this is because the order sizes, when you compare the Bitcoin ETFs to other types of ETFs, and there's a bit of a question as to whether that's apples to oranges or not. But I think reading the tea leaves, the order sizes that are coming in are still actually pretty small, which indicates this is a lot of retail activity. I think this is very good news actually for Bitcoin because everybody expected the ETF is what unthrottles the institutions. And if what we're still seeing is a retail phenomenon, then that means, assuming this is going where we think it's going to go, which I still believe it will, the institutions are yet to come. And they're coming a little bit more. But I think that means that we're going to see, yes, a lot of strong inflows as the institutions come in. And remember, of course, institutions don't whimsically decide to invest in Bitcoin. And they weren't all ready before the ETF was approved. They're like, let's see if it gets approved. Now it goes through a number of layers of analyses, investor committees, and all that kind of thing. And they will come in. But I think, we've still got a couple of months before we start seeing that volume tick.
So tailwinds, we have these new distribution channels. We have heightened awareness. People obviously have inflation top of mind, which maybe brings them to Bitcoin as a potential alternative to everything that we're seeing across the world and even at our kitchen tables in some instances. But in terms of headwinds, right, like the market itself hasn't really fixed a lot of the problems. If anything, it's almost a bit, scary that we're back at 70K without any sort of real trading infrastructure replacing the old regime that cracked down once we started hiking rates. And to an extent, the meltdown in crypto credit was a sort of derivative of the sort of macro picture. Should investors be worried that there might, what's to sort of prevent another breakdown in sort of our trading environment or even credit, although obviously the age of the under-collateralized loan is in the dustbin of our crypto history, it seems. But should investors be worried about things breaking, right? I mean, one question, and not to, I can get on tangents sometimes, but right, like, a lot of people have been asking, why don't we have circuit breakers with Coinbase sort of going down in certain periods of volatility, or other sort of guardrails that we've even touched on during this conversation to just make it more robust? Because if you look at the trading and the volatility, it's still, I don't think you can say it's robust.
Look, there's, I think, two parts of it. One is there's always more work to be done, and we should be on a continuous making it stronger path for forever. The reality is that securing $1 million is a different effort from securing 10, which is a different effort from securing $1 billion or $1 trillion, right? So as we ratchet up, we have to continue to make robustness and security much stronger. I think the players that are in the space, and I criticized Coinbase a little bit earlier, but I'm going to give them some credit here. Like, I think they are a more robust exchange actually than most of the other players were, especially when you had these earn programs and things like that. You mentioned Kraken, also super good. Bitstamp, super good. So I think some of the players are better. Does that mean that we don't have more improvement to do, both individually? I'm sure each of them has actually a lengthy roadmap of self-improvement to be done, but also, market structure-wise, of course we do. So I do share some of your concern, like, are we getting ahead of like where we should be? I wouldn't say that yet, but I do think this is a thing that like everybody needs to really pay attention to, and we don't have forever. Like, we need to jump on these issues. So that would be, of course, building market structure in a better way, getting transparency stronger, things like that. Another area is going to come up quickly, which is that the ETFs, right, are obviously going to be holding large amounts of asset. Do we diversify them? Do we have them all just having, one big pile of money somewhere? No, we need to make sure that we really move forward on these initiatives.
No, I think everybody's for that. That's got to be the future for these funds, at least, 2, 3, 4.
And then I think also for the Bitcoin folks, we talk about centralization and decentralization. Here we've been talking about compliance and regulatory, which is, pretty much entirely under a centralized construct. BitGo does a lot of centralized work. But I do think we also have to continue to figure out how to decentralize this. And this is not just a matter of, being a decentralized for the sake of being decentralized. It's actually a way of mitigating risk, right? Like when everybody's got pockets of asset that are distributed around globally across millions and millions of people instead of having large central pools, it strengthens the entire system. So it really is a mandatory component. And I know we haven't had internet cash before, and that scares regulators, both because their existing rules don't work and also because it's now global, whereas they used to be able to regulate locally. So these are problems that have to be solved that you didn't have to solve before you had internet money. Now that you have internet money, we have to solve them. So anyway, all of us should be working super hard to make sure that we continue on the innovation front, continue to invest in technology, and continue to push market structure.
Why haven't we seen firms like certain firms in the institutional custody space make great strides in rolling out products? Because if we think about, going to the top of the conversation, so many firms' first product or the sort of journey that they make in exploring crypto is through custody. If you go back to 2018, I think Citi sort of started with custody. Obviously, back 2018 started with custody, and then I'm sure, there's a long list of firms, whether it's State Street or Bank of New York Mellon, that have all dabbled, but no one's really, just completely dominated that segment from the institutional traditional finance category. Why do you think that is?
You mean, why is traditional finance not winning?
Yeah.
I think it's actually very easy. It's the innovator's dilemma. And I don't know, you probably heard me talk about this before, but at the risk of being redundant, if you're in Silicon Valley and you ask about The Innovator's Dilemma by Clay Christensen, like everybody knows the book. And the problem it deals with is, why is it that you can have a juggernaut like an IBM or a Microsoft that has all the money, all the client reach, the best developers, best engineers, all the assets and resources, and yet invariably they falter to some smaller company that comes out and figures out how to do it better? The banking, if you go to the East Coast, they've never heard of the Innovator's Dilemma. And the reason they never heard of it is because regulation has kept out innovation for decades. The reason we just have these small number of firms that keep getting bigger and bigger and bigger is because the regulatory hurdle of deploying new companies is so large that most people can't get through it and build a business. It's a real challenge. Some of the folks in our regulatory and legislative space are appreciative of the idea of innovation and needing to have it come forward. But also when it comes to money, it's people's life savings. Their lives are at stake. Yeah. So can you afford innovation? All right, so inside of every single one of these firms, they have a large, good business that makes a lot of money, and they understand a relatively low risk against that business. They have the blessing of their regulators, and they're operating it effectively. And they're instead of the 0 to 1, I guess to use another book analogy from Silicon Valley, instead of 0 to 1, it's the 1 to many guys that are really looking at how do you operate that at scale. And when this little tiny thing called Bitcoin comes along, they're not sure what to do with it. It's outside of their repertoire.
It's outside their realm.
All of a sudden, it's got no revenue and all the risk. And you do that wrong. Like, let's take Signature Bank. Your bank got shut down. Now, everybody knows. Heck, even Barney Frank, right? One of the co-authors of Dodd-Frank, recognizes that this is a bank that was shut down. A bullet was put in its head by legislators and regulators that did not need to be shot. And why were they shot? Because they went the wrong way on regulation relative to what their regulator wanted. The bank was solvent, did not need to be shut down. It was shut down. Okay, so if you're JP Morgan watching that movie, what are you going to do? You're going to kowtow to what the regulators and legislators want. You're going to get up there in front of Congress, and you're going to say, if I were you, I would shut down Bitcoin. Does he think that? Who knows?
Yeah.
But he doesn't want to be the next signature.
Yeah. And also, I mean, there's probably a fear that because they're operating outside of this realm, they can grow in a way that probably would never be possible for a fintech. They're just going to get acquired at a certain point, versus actually grow to be the acquirer or the dominant market player.
Yeah, I guess my gut, and I guess we'll see how it plays out. There'll probably be examples kind of from every direction. Inside of the technology, Silicon Valley space where I come from, of course, we're used to this idea that you see a lot of mergers and acquisitions and gobbling things up.
Mm-hmm.
When it comes to buying regulated entities, it gets a little different. Or when it gets to buying of even non-regulated entities, but that have been participating in the financial fintech or movement of money space. And the reason is because the acquirer inherits the sins of whatever came before from the acquiree.
Mm-hmm.
So, can a JP Morgan ever really acquire a sizable company like a BitGo or Coinbase or whatever? They might have the money, they might have the will, but would they, again, be willing to take the risk? So I don't know what the answer to all these questions is going to be. There still definitely is regulatory uncertainty with the SEC, for sure. The part that BitGo deals with, there's no regulatory uncertainty. We know exactly what we're doing, and our regulators are aligned with it. But that doesn't change the fact that when it comes to M&A, you have to kind of look under the covers and see if everything is copacetic from the acquirer's point of view. I think what we're going to see Innovator's Dilemma striking the heart of Wall Street, and the largest companies in finance of the future are going to be those that started in digital assets. It's going to be Coinbase, it's going to be BitGo. It's not going to be JP Morgan, it's not going to be Goldman Sachs, and it's not going to be State Street.
We'll see. I think a lot of people listening probably agree. Mike, thanks for taking the time. Anything you want to leave listeners with before we turn off the mics? Any maybe where they can find you or learn more?
Well, since we were just there, we just acquired a company called Brassica a couple of months ago, and there's this segregation of digital assets to the left and TradFi equities and stocks to the right, and there's like zero bridges between them. Mm-hmm. You can sort of call the ETF a little bridge between these two worlds, but for the most part, two worlds operating in two different planes. And with the acquisition of Brassica, which is not a digital asset company, Brassica focuses on private equities. And what they do is a very technology-first way. So it's actually similar to what BitGo does. How do you take digital assets and embed it API-wise, white label-wise, into applications as an institution? We made that possible for digital assets. We pioneered. We were the first guys doing that back in 2013. And then Brassica does the same thing with private equities. And they've got a full regulatory compliance stack they've got custody behind the scenes, they've got transfer agents behind the scenes, and a whole bunch of technology.
Interesting.
And so we are actually the first company that's bringing together both of these worlds in one house. So to answer the question of will the digital asset companies grow to be the ones that are handling all the other assets, or will the traditional firms grow to handle all the digital assets? We're placing our bets, and we're going to try to make sure we can provide all the services our clients are looking for, regardless of what type of asset it is.
Super interesting. Thanks so much, Mike. Really appreciate you taking the time.
Thank you.
Yeah, we'll see you soon.